Greetings, everybody. Straighten my collar out here. Thanks for joining me on this Monday. I always have to check the calendar here, December 6th. And again, where does the time go when you're having so much fun? I mean, it's been just a riot act this year in the markets. Clearly, things have been, stocks have been doing pretty well until lately. Lately, I'm starting to see quite a bit of nervousness out there about the potential for this market to continue to move higher. I guess people have lost their confidence in the Santa Claus rally, and the concerns are the new variant of the virus, and concerns about Fed Chairman Powell that just last Tuesday he pivoted yet once again from being very dovish to being relatively hawkish. Again, in the book I wrote in 2020 called Fed Watching, the chapter on Powell is called Jerome Powell, Pragmatic Pivoter. So here he is doing it once again. And I mean, to his credit, he's more or less conceded that he was wrong about inflation. It wasn't transitory. Let's face it, that was the consensus view until recently. And in many ways, he's sort of been leading the consensus. He thought it'd be transitory, so did everybody else. And then he came to realize that, well, wait a second, there's some problems in the supply chains, and everybody else started to see the supply chain issues. The supply chain issues, of course, aren't just a supply phenomenon, they're also a demand phenomenon. He has yet to concede, maybe he won't concede, that the awesome amount of fiscal and monetary stimulus that was provided since the pandemic created a demand surge. And as a result of the demand surge, the supply system was absolutely and totally overwhelmed. As I mentioned to you before, if you look at West Coast traffic, look at containers that are actually being downloaded. I don't know if that's the expression for containers, but on a 12-month basis, the containers are an all-time record high. So it's not as though the stuff's not getting through, it's just not as much as we want is getting through. And meanwhile, there's lots of evidence that the economy continues to do extremely well. Well, without further ado, let's look at the charts here that are relevant to this discussion related to the morning briefing this morning. Let's once again go to the website here. And along the way here, I'll remind you that you can click here to get an exclusive free download of my latest book on profits. There's, but again, let me not take up too much of your time here. Let's go straight to the morning briefings. I like to go there. And this will open up the chart book. So here you can see that for all the fears about how the economy is slowed down and might be vulnerable in the supply disruptions, the Atlanta Fed's GDP now tracking model is tracking real GDP at an annual rate of almost 10%. I think the latest number is 9.6%, and that reflects the latest data that's come out, like on employment. So it's quite a improvement from the slowdown we had here, which was 2.1%. Look at the pattern here. We had over six in the first and second quarters. Third quarter, we had 2.1%. I thought that a lot of that was related to supply disruptions. We know that without the inventory story there, we would actually have been flat to down on real final sales. But here, I'm resisting what I'm seeing in the Federal Reserve Bank of Atlanta's real GDP number, because they're again talking 10%. So we've upped our number from 2% to 5%. I just find it a little bit hard to believe we're going to see a 10% number. But then again, there's so much stimulus in the system, and that's what the numbers are showing. And here it is early December. So we already have a bunch of economic indicators that are all pointing to a 10% increase at an annual rate in real GDP. And then, at least in our forecast, we have it coming back down to a more normal trend of 2.5, then 3.3. And the reason it gets better is we're still believing that productivity is going to kick in here. By the way, if this is what real GDP is doing, And we know that the payroll employment numbers have been weaker than expected. The productivity numbers in the third quarter are going to make a phenomenal comeback. They took a big dive in the third quarter, as real GDP slowed down and we saw a lot of employment. But now that may reverse just in one quarter, and we may just have a very, very strong productivity number even in the fourth quarter. The leading indicators, the year-over-year percent change in leading indicators, you can see are highly correlated with the real GDP. Let's see, I just want to make sure. I want to look at my cues. Okay, I'm just getting some questions, which is fine. I'll get to them in a minute. But I wanted to see that none of you were saying, I can't hear you, I can't see you, like Tommy and the Who. We could talk about that another time. But I will talk about another song here while I'm distracting myself, and that is Should I Stay or Should I Go by The Clash. I gave you a link to the YouTube video on it, and accounts are asking me, should they stay in the market or should they go? So we'll get to that in a minute as well. But again, the leading indicators are looking just fine for real GDP growth and are consistent. You can see that on a year-over-year basis, they tend to exceed the growth in real GDP, but the basic cycle is the same. And the basic cycle is that the economy is still doing just fine. Speaking of that, look at the CRB Raw Industrial Spot Price Index. Even with the Fed talking about tapering at a faster pace, they're still at an all-time record high. They're holding up fairly well. Does not include oil, does not include lumber products. I like it that way. I like to separate them out. But as you can see, the commodity prices are still holding up pretty well. I haven't looked at my boom bust barometer for a while, but when you look at the ratio of the CRB raw industrials and divided by initial unemployment claims, you get a pretty good weekly indicator of what the US and global economies are doing. I mean, let's face it, the CRB index is determined by global economic activity. Initial claims are almost all determined by what happens here at home. But it's got an awfully good track record of telling us that things are starting to slow down before recessions and then bottom at recessions. And we've had the world's fastest business cycle on record with a 2-month recession back here, leading to a free fall in the boom bust barometer as both commodity prices and went down and initial claims soared. And now we've seen commodity prices soaring while initial claims took their sweet time to come down, but now they're below 300,000, around 200,000. And so the boom bust barometer is at an all-time high. So that's certainly consistent with a boom in the economy. And then the MPMI and NMPMI came out, and the MPMI is doing pretty well for all the talk about supply disruptions. The new orders came down, but these are all still at cyclical highs. So the manufacturing sector looks just fine. They're looking to hire some people. Now look at the non-manufacturing, all-time record high for the red line for the total NMPMI. And if you look at the components, you'll see that production and new orders are very strong. And they too are looking for people, as we know. So that confirms things are humming along. How about the supply disruptions? Well, we have this data from the MPMI for the manufacturing purchasing managers. You can see the supplier deliveries are still taking a while. So that's still consistent with disruptions, with lags in getting parts and such. Backlog of orders, that seems to be coming down a bit. So that's mildly encouraging. The new orders index for purchasing managers came down. Production is up. So they're at least in the same ballpark now, almost identical, which again suggests that production is staying in pace with orders. On the other hand, the customer inventories index remains extremely depressed. So all in all, there's still supply disruptions out there. They don't seem to be everywhere. They seem to be to a large extent in the auto industry, and maybe some retailers waiting for containers to be offloaded. But look at the data here on durable goods orders. Durable goods orders, especially this one. This is durable goods orders and shipments excluding transportation. And you can see that the shipments have been keeping pace with orders, and they're really one on top of the other. That's even a tighter fit than usual. So that certainly gives me some comfort that the supply disruptions story may be somewhat overstated and may not be that much of a disruptor for economic growth. The capital spending indicator in the durable goods orders is this series here, non-defense capital goods orders and shipments excluding aircraft. And you can see there's a little bit more of a lag between shipments and orders, but you'd expect that with capital goods orders. They take a while to manufacture and deliver. Meanwhile, the auto industry, that's where the problems are. They're still waiting for semiconductors to finish off some of these cars, but they have had a little uptick in domestic light truck sales, which is where a lot of their profits are. Meanwhile, I guess they're probably, the foreign imports are having the same problems getting chips. And then, of course, the domestic industry for autos, domestic autos or cars, I should say, is still very depressed. So that's one area where the disruptions are still certainly there. But the income numbers, the employment numbers that came out on Friday certainly confirmed that consumers are still in very good shape. I know there's some disappointment about the strength of the payroll employment numbers, but the household measure, which measures the number of people who actually have jobs as opposed to the number of jobs, rose to an all-time record. Well, not an all-time record high. It rose by over 1 million, whereas the payroll rose by over 200,000. That's where the disappointment was. But a lot of the strength in the household data is in fact in full-time employment, which is a very encouraging development. But when the data comes out, we immediately calculate our earned income proxy, which is a very good proxy, as you can see, for wages and salaries in personal income. And in November, it continued to go up as wages went up 0.2, as the number of hours in the week worked went up. And so that still looks good. It doesn't look as good if you deflate this by the consumption deflator, because quite a bit of the increase of late this year has been absorbed by higher prices. But again, here's private payrolls, ADP, BLS. They used to track each other really, really closely. They still do, just not as closely. So I wouldn't dismiss the information that we got from the ADP data. I don't know, that number looks wrong to me. It should have been 500,000. So we'll correct that. The household employment data, as you can see, again, has been very strong. We're not back yet to where we had been at a record high, but we're making some pretty good progress in terms of full-time employment. And those you would think are better jobs than part-time employment. And then the unemployment rate has dropped substantially here. And there's two components to it, the short-term and long-term, that we like to look at. Debbie and I look at these numbers quite closely, and you can see that the long-term unemployment has come down, just coincident with on September 6th, the federal government no longer providing the extra supplemental unemployment benefit. So there's certainly some evidence that ever since the unemployment benefits became less generous, that people decided it was time to go back to work. So maybe some of these people who were on long-term unemployment more than 27 weeks decided, let's get back and look for a job. And it's not that hard to find them, as we all know. And then look at the short-term unemployment. This is what Powell's been looking at, and has come to the conclusion that it's time not to be so dovish and time to be, at least talk more hawkish. What about consumer confidence? Why is that looking kind of weak? We average out the consumer sentiment numbers with the consumer confidence numbers. Both of them are monthly, to just take an average and call that the consumer optimism index. And it's come down some, and I think it has a lot to do with inflation going up and affecting a lot more people's misery than the unemployment rate coming down. So that's a bit of a hurdle, and maybe it's one of the reasons that consumers are sitting on so many deposits. But then again, Americans are born to shop. When they're happy, they shop. When they're depressed, sometimes they shop some more. So I'm not particularly concerned about the misery index or the confidence data. I am concerned about the inflation story, and it looks as though the PMI data, the purchasing managers data on prices paid and prices received, looks like that's topping out. But keep in mind, this is a diffusion index. It's not a year-over-year percent change. It's month to month. How are your prices this month compared to the month before in terms of prices paid? And what you can see there is that more and more of them are saying it's just as bad as it was the month before. So you kind of wind up hanging out around here. I think this is probably peaking out as the supply disruptions become less of a factor. And I also think productivity is going to kick in. And then look, there should be some slowing down in demand relative to the strength we've had in the past year or so. This is the regional surveys on prices paid and prices received. The PMIs don't have prices received. And there again, it's hard to get too excited that anything good is happening on the inflation front right now. But when we look at the wage price spiral, we are seeing some evidence that rising prices are spiraling into wages. All wages are 4.8%. Before the pandemic, they were 3%. So it's an increase, and it's a significant increase. But when we look at the higher wage workers versus the lower wage workers, what we see is the lower wage workers are not beating inflation. They're underperforming inflation and getting an increase of 2.5%. And they account for about 20% of the labor force. The lower wage workers are up 5.9%. And we know the consumption deflator was up 5%. So they're slightly beating the wage numbers. So that's certainly a wage price spiral. When you see wages going up and workers turn around and say, well, wait a second, prices went up as much. I think that's a pretty good definition of a wage price spiral. So we have some of that happening right now. This just shows you that the low wage workers account for about 80% of the workforce. Well, now let's look at some of the things relevant to the stock market. I'll try to leave some minutes to respond to your questions. Hopefully I covered some of them here. But the fundamentals of the stock market are fully consistent with the strength we're seeing in the economic indicators that I just went through. And again, given all the bearishness that I see out there, concerns about everything that could go wrong, right now things are going right for the economy. I know it's hard to imagine or believe based on the sentiment, but that's the way it is. And forward revenues for the S&P 500, 400, 600, the mid caps and the large caps, all-time record highs. Pretty good, right? I mean, and these are forward revenues and good coincident indicators of actual revenues I found. How about earnings? Forward earnings, all-time record highs for all of them. You'll notice that the mid caps are actually stronger than the large caps, and you'll also notice that the large caps may be now starting to lose their V and kind of get more along with the historical trend, which will be consistent with about 6, 7, 8% growth in overall S&P 500 earnings, which is what I'm expecting going into next year and the following year. Profit margins, fascinating, right? I mean, they've really come back and then some. You've got, I think, record profit margins. If you look across the board here, this is the S&P 500, still making record highs for the forward profit margin. Then we've got the mid caps kind of sideways action at a record high, and the S&P 600 at a record high. I mean, that's very impressive, given all the anecdotal stories we have about labor shortages, about labor costs, commodity costs going up. So some of that is they're passing those costs through into prices. And some of that, I think, is productivity. And I think more and more of it's going to be productivity. Now, the bad news. The bad news is valuation. While the mid caps have been going sideways, they actually had a good week prior to Friday. And then Friday, they got whacked. And as you can see, the forward PE of the S&P 600 dropped to 14.4. 15.7. I mean, they're getting to be relatively cheap, or at least fair value. Most people think 15 is about fair value for the large caps, whereas mid caps usually are viewed as fair value, something like 17, 18. So they're looking pretty cheap, especially relative to the large caps. One of the questions I had come to me before the session here is, well, what about these highly valued large cap companies? Can they maintain their valuation multiples, or some of the downward action we've seen recently, is that where we're heading? I'm still a big believer that there's just so much liquidity in the system that'll keep valuation multiples relatively high. Somebody also pointed out to me they're getting a sense of deja vu, where the large caps had a higher valuation multiple than the small caps back in the late 1990s, which I don't have on this particular chart. Let's finish this off with the blue the Blue Angels. This is the Blue Angels for the S&P 500, 400, 600, and it gives us sort of all in one picture, the PE times E analysis for the market, where I'm using forward earnings. And you can see forward earnings still rising to record highs. Forward earnings multiplied by 10, 12, by these kind of multiples. We're still in this, and again, this is through Friday. So we're still in this 2022 range on the forward PE. It's my assumption that it's going to stay relatively high around this level, and that the market will go up along with earnings, and that earnings have the potential to continue to grow at a relatively good mid to high single-digit pace. This is what we were talking about, the SMID caps. Look at the mid caps here. Their price went sideways, had a little rally here, gave it all up. And you can see that it's bizarre, but the forward earnings of the mid caps and large caps are actually outperforming. Let's do that again. The forward earnings of the mid caps and small caps are outperforming in terms of the ascent, the percent increase in forward earnings. And yet, as a result of that, because the prices are going sideways, their PEs have taken a dive. So with that, let me look at some of the questions that you folks have kindly sent in. All I got to do is find that. Okay. Kathy Wood says the environment would be deflationary in the next 3 years. Is it likely? Kathy's a smart lady. She's certainly done an amazing job of creating an amazing business. I know her portfolios have done really well until recently, not so well. But she's a smart lady. She's trained as an economist. I know her quite well. And I think she does tend to be an outside consensus thinker, and thinking that we could have deflation in the next 3 years is certainly outside the consensus. I was sympathetic to that kind of view prior to the pandemic and prior to all the fiscal and monetary stimulus that has been provided. I think what's changed since the pandemic is MMT has come into fashion, modern monetary theory. And once governments get the hunkering for even more spending and more monetary stimulus, it's hard to see how they just suddenly reverse it. So I think I'm still a disinflationist. In other words, I'm looking for inflation to be 4 to 5% this year through the middle of next year, and then come down to not 2%, but 3 to 4%. And in that scenario, I think the Fed might very well decide that they have to raise their inflation target. I know I think I'm the only one even positing that possibility. Somebody told me it was controversial. I said to them, "You mean I'm the only one talking about it?" I said, "Yeah, you're the only one talking about it." So maybe it's too far out on the limb, but if they can't get inflation back down to 2%, I think rather than get stuck with being forced to raise interest rates a lot, they might back off. By the way, speaking of that, because of Powell's hawkishness, we clearly have seen that the 2-year Treasury note and the 12-month futures market are now factoring 2.5 increases on the Fed funds rate, or 25, and another 25 is a possibility next year. But the yield curve is interesting because maybe it's this risk aversion. We're seeing people running into the Treasury bond yield, even though there's all this talk about the Fed tapering at a faster pace. And so the yield curve spread is actually narrowing between the 10 and the 2-year. And a narrowing spread between the 10 and the 2-year is actually a warning signal that if the Fed does tighten, it risks causing some sort of financial crisis. So we want to watch not only the 2-year and the Fed funds rate where it's going, we also want to watch that yield curve spread as a possible indicator of trouble. I'm perfectly willing to recognize it when I see it, but right now things still look pretty good. What do you think about the premium of large cap versus mid caps? It seems tremendous in late 90s, and we all know what small caps did during the tech meltdown. They boomed. That's okay. I mean, I think this, Doug, I think you were the fellow who kind of posited this question before. I'm glad you did it again. I sort of covered it, but there is a sort of deja vu, as I said, between the large caps outperforming the mid caps now compared to the same kind of behavior in 1999, 2000. And then it was a long period of being in the desert for the large cap techs anyways. I don't think the large cap techs have a desert future ahead of them. I think they've got a very good future ahead of them. I think mid cap technology has a very good future ahead of us, ahead of them. So I don't think you've got to see large cap tech or large caps generally doing poorly for mid caps to do well. I continue to believe that they are remarkably undervalued. Some people, the press always has to have some explanation for why these things are happening. And so the press seems to be saying, well, it's the Omicron virus that's hurting the outlook for growth and therefore small caps. But again, they always need to have some sort of explanation, and I just don't buy it. I mean, their fundamentals are really, really good. Job numbers on Friday were weak at 210K. Household employment was high, was the headline. Where can I check the household employment value? Some of these questions came in before I actually went into my shtick here, so I think I covered some of them. But if you want to see the household employment data, you can always go on our website, and we have a whole section on the consumer, and in there we have all the household data in addition to the payroll data. If you want the original source, you just go to the Bureau of Labor Statistics employment report, and when it comes out, there's tables on that information. Inflation is high, but dollar is strong. How to understand this correlation? Interesting what's going on here. Don't fight the Fed. So the Fed now is talking more hawkish. The dollar's been sort of anticipating that, and so the dollar's been relatively strong, which is contrary to what the beliefs were even a year ago. People were generally pretty bearish on the dollar. So here the dollar is strong. The strong dollar tends to be highly correlated either in a causal way or some karma way with weaker commodity prices, particularly oil prices. And sure enough, as the dollar strengthened here, we've seen some weakness in commodity prices. I would say that this gives some confirmation to the outlook for those of us who think that inflation isn't going to be like the 70s. It isn't going to make a big comeback or be persistently here for the foreseeable future, but that the worst of it should be over by the middle of next year and should be moderating again. So that's what I'm reading from the dollar and from the action of some of the commodity markets right now. What is the most attractive value in credit markets today? That's a tough one. Nothing's cheap. Everybody's been reaching for yield. There's been a tremendous increase in leveraged loans. There are a lot of leveraged loan funds that have pretty good yields, but they all look pretty good until we get the next credit crunch or credit crisis. But I would say industrial grade bonds are probably attractive relative to treasuries and give you some cushion against credit issues. As you probably know, the credit spreads between the high yield bond composite and the treasuries has actually widened recently. Now, is that a signal that we're about to have a credit crunch? I don't think so. It's a little too early. I think we have seen certainly a flight to quality, risk aversion among some investors, pushing them back into the 10-year treasury. The 10-year treasury has been truly one of the great conundrums of the year relative to expectations of inflation, relative to expectations of what the Fed will do. Let's see, I think we got another minute or two. How do you determine, calculate the forward PE multiple? That's, we take the price and the forward earnings is the time-weighted average of analysts' expectations for this year and next year, and that's forward earnings. So at the beginning of a year, the actual the earnings expectations at the beginning of the year just reflect what analysts are expecting for the year ahead. Once you get to the middle of the year, then you take half of their expectations for this year and half for next year. So it's a time moving average of analyst consensus expectations, and it tends to be a really, really good leading indicator of actual earnings, with one important exception: it doesn't see recessions coming. That's what we got to do. That's my job, and some of you obviously do quite a bit on your own. Seeing a lot of notes everywhere that dedicates markets like options are moving main markets. Is there any truth to it? I think there's some truth to it. It looks like the retail investor has become a bigger factor in the recent volatility in the marketplace. We saw it with Robinhood, we saw it with MEMS. Now I think we're seeing it in the options market. The put-call ratio soared on Friday to 0.73, which is the highest since April 2nd of last year, which was just still very much in the pandemic, still in the lockdown phase. So somebody got scared, or maybe it's institutions that got scared, and the individuals are still buying on the dips. But it's always tough to answer that kind of question, because when the market's like down 1,000, the Dow's down 1,000 points in a flash crash, we all come up with it's the algos and things like that, and then everything kind of calms down and we move on to other issues. But just more buyers than sellers when the market's going up, and more sellers than buyers when the market's going down. But the fundamentals still look quite good to me. The valuation, I'm not telling you anything's cheap, but especially in an environment where the Fed's expected to be raising interest rates. But they say that if the Fed's raising interest rates, the bond yield should be going up, and that should be good for financials and not so good for growth, but the bond yield's going down. So go figure. Anyways, I haven't completely given up on the Santa Claus rally. There's still time. So I'm looking up on the roof between now and year end. Thank you all for joining me today, and let's do this again next week. All the best to all of you. Have a great week.